everyone. Welcome back to the course on International Financial Management. Over the past lectures, we have built a rich and comprehensive framework of what impacts understanding exchange rates, because understanding what drives exchange rates is only half the battle. The other half is being able to look ahead and make informed predictions about where they are going. This is the practical frontier of everything we have studied so far, and it is what today's lecture is all about, which is forecasting exchange rates. Let me begin by asking why forecasting matters at all. Why do businesses and investors simply wait and see what exchange rates do? The answer is that exchange rate movements have very real and very immediate consequences, and by the time the movement happened, it is often too late to act. Consider a company that imports raw materials from the United States and pays in dollars. If they sign a contract today for delivery 6 months from now, they are exposed to whatever the rupee dollar exchange rate will be at that time. If the rupee weakens significantly, their cost in rupee terms could jump dramatically, squeezing their margins or even turning a profitable contract into a loss. Or consider an investor who places funds in foreign country. Even if they earn a healthy return in local currency terms, a sharp depreciation of that currency when they bring their money back home would wipe out the entire gain and maybe some of the gain. And from a policy perspective, a central bank that fails to anticipate currency misalignment may find itself reacting to crisis rather than preventing one. Exchange rate forecasting is therefore not an academic luxury. It is a core practical tool in international financial management used every day by treasurers, fund managers, traders and policymakers around the world. Now, there are three broad approaches to forecasting exchange rates, and each has its own logic, its own tools and its own strength and limitations. The first is fundamental forecasting, which looks at the underlying economic forces that drive exchange rates. The second is technical forecasting, which looks at historical price patterns and market behavior. And the third is mixed or combination forecasting, which brings together the best of both approaches. We will study each of these in turn. Let us begin with fundamental forecasting. Fundamental forecasting is built on a straightforward and intuitive premise. Exchange rates are ultimately driven by underlying macroeconomic forces. If we can understand and measure those forces, we can forecast where exchange rates are headed. They should feel very familiar. Everything we have studied this week, whether it is PPP, IFE, IRP, the income effect, the portfolio balance theory, all of these are fundamentally about how economic variables drive exchange rates. Fundamental forecasting is a practical application of all that theory. A fundamental forecast can be generated in two ways. The first is through subjective assessment, where an analyst or economist look at the economic conditions in two countries and form a judgment about the likely direction of the exchange rate. This is qualitative and relies on experience and expertise. The second approach is quantitative, and the most common quantitative tool is regression analysis, which we will come to shortly. But before we get to the mechanics, let us think about which economic variables actually matter most in fundamental forecasting. The first and perhaps the most important pair of variables are inflation and interest rate. We know from PPP that higher inflation in a country leads to depreciation of its currency because its goods become relatively more expensive and demand for its currency fall. And we know from IFE and IRP that higher interest rates attract capital inflows, strengthening the currency. Both of these are captured in fundamental forecasting model through the inflation differential and interest rate differential between two countries. The second variable is the GDP growth. Country growing faster than its trading partners will generate higher income and stronger demand, including demand for imports. As we saw with the income effect theory, this puts depreciation pressure on the currency. But the strong GDP growth also signals economic health, which can attract foreign investment and support the currency. The net effect depends on which force dominates. The third variable is income levels. Rising incomes, as we discussed, increases import demand, and higher imports mean more demand for foreign currencies and more supply of the domestic currency in the forex market. This tends to weaken the currency. The fourth is government controls, which are tariff, import duties, quotas, capital controls. All these central bank interventions directly affect the supply and demand for currencies. A government that restricts imports, for example, reduces the demand for foreign currency and supports its own currency. These policy variables must be factored into the forecast, which is fundamental forecasting. The fifth variable is the current account balance. A country running a persistent current account deficit means they are importing more than they are exporting, typically creates greater demand for the foreign currency in the foreign exchange market. Over time, this can put upward pressure on the foreign currency and it may eventually appreciate. And finally, political stability. A country experiencing political uncertainty, governance crisis or geopolitical risk will see investors become nervous. Capital tends to flee uncertain environments and that capital outflow puts sharp downward pressure on the currency. Political risk is difficult to quantify but impossible to ignore in a comprehensive fundamental forecast. Notice that every single one of these variables connects directly back to the theories that we have studied this week. Fundamental forecasting is not a separate discipline. It is the applied expression of all the theory we have built. Now, let us look at the most important quantitative tool in forecasting, which is called regression analysis. Regression analysis formally estimates the statistical relationship between the exchange rate movements and the economic variables we have just discussed. Instead of relying on judgment alone, it uses historical data to calculate precisely how sensitive the exchange rate has been to changes in inflation, interest rate, GDP and income, and it uses those estimated sensitivities to generate forecast. The general form of the regression model is ET is equal to alpha plus beta 1 del inflation plus beta 2 into del interest rate plus beta 3 into del GDP plus beta into del income plus the error term. Let me walk you through what each component means. ET is the percentage change in the exchange rate in period T. This is what we are trying to predict. Alpha is the constant or intercept, the baseline exchange rate change when all other variables are 0. Beta 1, beta 2, beta 3 and beta 4 are the regression coefficients They tell us how much the exchange rate changes for a 1 unit change in each respective variable. Del inflation is the inflation differential between the two countries. Del interest is the interest rate differential. Del GDP is the GDP growth differential, and del income is the income growth differential. And E is the error term, capturing everything the model cannot explain. So, how does this actually works in practice? Let us go through this step. The first step is to identify the key economic variables that you believe influence the exchange rate you are trying to forecast. For a rupee dollar model, that might be the India US inflation differential or the interest rate differential and GDP growth differential. The second step is to collect historical data, perhaps quarterly data over the past 10 to 15 years on both the exchange rate and all the independent variables. The third step is to run the regression using this historical data. The regression output gives us the estimated coefficients, the beta values, which tell us historical sensitivity of the exchange rate to the each variable. The fourth and the final step is to use these estimated coefficients together with your forecast of independent variables for the future period to generate an exchange rate forecast. Now, let us see this question and let us see how it works. So, we have this alpha, which is the intercept, then we have this variable which is inflation differential, we have another variable which is interest rate differential, we have beta 1 which is the coefficient of inflation differential, and we have beta 2 which is the coefficient of interest rate differential. Now, we have got this through the regression equation because we have regressed. What we have regressed? We have regressed the changes in exchange rate with these variables, and we found these relationships among those variables. This is the dependent variable and these are independent variable. Now, after getting the equation, we find that we are expecting something in future, and what are we expecting? That there is the inflation rate differential is going to be 3%, while the interest rate differential is going to be minus 2%. Now, we put this into the equation. So, our ET, that is the expected exchange rate, is going to be into plus minus 0.5 into minus 0.02. Now, this gives us a value 3.6%. So, this means that the rupee might depreciate by 3.6%. So, your forecast is that the rupee will depreciate by 3.6% over the coming period. This is the power of regression based fundamental forecasting. It gives you a disciplined, systematic and quantifiable forecast grounded in the economic theory. But like all tools, fundamental forecasting has its limitations, and it is important to be honest about them. The first limitation is that a regression based fundamental forecast is only as good as the input forecast. If your forecast of inflation or GDP growth is wrong, your exchange rate forecast will also be wrong. You are effectively forecasting a forecast which compounds the uncertainty. The second limitation is that regression coefficients are estimated from historical data, and the relationship between economic variable and exchange rates can change over time. A coefficient estimated from a data in 1990s may not hold in 2020s. Structural breaks, policy changes, and shifts in the global financial markets can all alter the underlying relationship. Third, fundamental models capture what economists call the rational drivers of exchange rates: prices, income, interest rates. But exchange rates are also heavily influenced by market sentiments, speculative flows, and political events that are inherently difficult to quantify and impossible to forecast with any precision. And fourth, and this is particularly very important, fundamental forecasting tends to work much better over medium to long time horizon than over the short term. In short run, exchange rates can deviate dramatically and persistently from what fundamentals would predict. Day to day, week to week, other forces dominate. Which brings us to the second approach, and that is known as technical forecasting. After understanding the exchange rate movements through economic fundamentals, we now turn to technical forecasting. Technical forecasting takes a completely different starting point. Instead of asking what economic forces drive exchange rates, it asks what do historical price pattern tells us about where the exchange rate is going next. Technical forecasting involves the use of historical exchange rate data, prices, volume, trends to predict future values. It is grounded in the observation that financial markets tend to move in patterns, and these patterns tend to repeat over time. And if you can identify these patterns, you can use them to forecast future movements. Crucially, technical forecasting does not care about inflation, GDP, or interest rate. It focuses purely on price, volume, and trend data. It is the language of traders rather than economists. Technical analysis include three broad categories of tools, that is statistical analysis such as moving averages and momentum indicators, time series models like such as ARIMA models and trend extrapolation, as well as chart patterns, which is most notably candlestick charts and support and resistance levels. Technical forecasting is particularly useful for short term and day to day exchange rate movements, which, as we have noted, are precisely where fundamental forecasting struggles. It is widely used by currency traders and speculators who need to make quick decisions based on market signals rather than lengthy economic analysis. The core idea behind technical forecasting is simple but powerful, that is, exchange rate move in trends. Once a trend is established, technical analysts argue it is more likely to continue than to suddenly reverse. If the rupee has been depreciating steadily against dollar for several consecutive weeks, making lower lows and lower highs, technical analysis suggests that the movement is with the downturn and it is more likely to continue than to abruptly turn around, at least until a clear reversal sign appears in the data. Now, here we see there is, in case of the downturn, we see that this higher, that is the consecutive higher, is lower than the previous higher, clear, and the lower, this particular lower is also lower than the previous lower. While in upturn, we will see that this particular higher is higher than the previous higher, and this particular lower is higher than the previous lower. There are three types of trends, an uptrend where the currency is consistently appreciating, making higher highs and higher lows with each passing period. A downturn where the currency is consistently depreciating, making lower highs and lower lows, and a sideways trend where the currency is moving in a narrow range with no clear direction, suggesting the market is in a period of indecision. Now, identifying which type of trend a currency is in and at what stage of that trend it is the foundation of technical forecasting. One of the most widely used visual tools in technical analysis is the candlestick chart, and understanding it is essential for reading price data the way a trader does. Each candlestick represents the price movement of the currency pair over a specific time period. It could be 1 day, 1 hour, or even 1 minute depending on the trading time frame. A candlestick has 4 components: the body, which represents the range between the opening price and the closing price for that period; the upper wick, which extends above the body to the highest price reaching during the period; the lower wick, which extends below the body to the lowest price reached. And here is the color coding that traders instantly read. A green or a white candle means the closing price was higher than the opening price, indicating that the currency appreciated during the period. A red or a black candle means the closing price was lower than the opening price, indicating that the currency depreciated. Now, let us talk about this. Let us say that when market opened, the price was 82 rupees per dollar. During the trading hours, the highest price was 82.50, while lowest price was 81.50. When market closed, the price became 82.25. Now, here we will see that the closing price which is how much? The closing price is 82.25 is greater than the opening price, fine. So, here we will find out, we will write here 82.25, and what is the opening price? The opening price is 82, and what is the highest price? The highest price is 82.50, and what is the lowest price? The lowest price is 81.50. Now, this is when the candlestick is green, that shows that the prices are rising. There can be a possibility when the prices are falling. So, here in this we can see the opening price is greater than the closing price. By reading a series of candlesticks together, a technical analyst can identify trends, reversals, and key price levels, all without looking at a single piece of economic data. Beyond candlestick charts, technical analysts use several important indicators to support their forecast. The first is the moving average. A moving average smooths out the short-term noise in exchange rate data and reveals the underlying trend more clearly. Traders typically track two moving averages simultaneously, a short term and a long term. When the short term moving average crosses a long term moving average, it generates what is called a bullish crossover, a signal that the currency is gaining momentum and appreciation is expected. When it crosses below, it generally shows a bearish crossover, signaling depreciation momentum. Now, let us understand how moving averages are calculated. Now, we can have a 3-day moving average or 5-day, 15 days, 1 month moving average and so on. So, if we consider, it can be even hourly. So, if I consider hourly moving average, so this is a very short term forecast. If I go for monthly, it is little longer, and I will see that the hourly moving average is more volatile as compared to the monthly moving average. Monthly average is going to be more smoother. Now, let us, just for your understanding, let us do three types of two moving averages here. One is 3 years and the other is 5 years. It is just to know how we calculate it. Now, how we are going to find it? We will, if it is a 3-year moving average, we are going to take the averages and we will move them by one data point. So, here it is, we take the first 3, we find the average of 20, 25 and 30, we get how much? 25. Then we leave the first one and we take the next 3. What is the average that we are getting? 30. We leave the second one and we move on to the next 3. The average is 35. We leave the third one, move on to the next 3, average is 40. We leave the fourth one, move on to the next 3, average is 45. Now, similarly, I can show you the 5 years moving average. Here we take the first 5. So, here we have 1, 2, 3, 4, 5. So, we will take the first 5, and what is the average? We are going to get this 30. This is the average of the first 5. Then we will leave the first and we will go to the next 5. The average is going to be of these 5 data points, is going to be 35. We will leave the second one, move it to the next one and we get another average which is called 40. So, this is how moving averages are calculated. Now, the second key concept is support and resistance level. A support level is a price point where the currency has historically stopped falling and bounced back upwards, because buyers tend to enter the market at that level. A resistance level is where the currency has historically stopped rising and reversed, because sellers tend to enter at that point. These levels are remarkably persistent in currency markets and serve as important reference points for traders deciding when to enter or when to exit. The third category is momentum indicators, tools that measure not just the direction of price movements, but the speed and strength of that movement. A currency moving upwards with strong momentum is more likely to continue than one moving upwards weakly. Momentum indicators help traders identify when a trend is healthy and when it is losing steam and may be about to reverse. Like fundamental forecasting, technical forecasting has its limitation, and a good analyst is always aware of them. The most fundamental criticism is that it is based entirely on past data. It assumes that history repeats, that patterns that worked before will work again. The assumption is not always valid. Markets evolve, participants change, regulatory environments shift. A pattern that was reliable for a decade may suddenly stop working. Technical analysis also completely ignores fundamental economic changes. If the Reserve Bank of India unexpectedly changes its interest rate policy, or if a geopolitical crisis erupts overnight, no chart pattern will have prepared you for that. Fundamentals can override technicals instantly and completely. There is also a self-fulfilling element to technical analysis that is worth thinking about. If enough traders follow the same signal, if everyone sells when the moving average crosses below, the patterns appear to work not because it has a genuine predictive power, but because collective actions made it happen. When the crowd behavior changes, the pattern breaks down. Technical forecasting also works best in liquid, actively traded currency pairs like Euro per USD or USD per Japanese yen, where there is enough data and enough market participants to make historical patterns statistically meaningful. For less liquid emerging market economies, technical analysis is far less reliable. And finally, technical forecasting is really a short term tool. It is excellent for helping a trader decide whether to buy or sell today or this week. It is not designed to tell you where the rupee will be a year from now. This is where fundamentals are needed. And this brings us naturally to the third approach, which is mixed or combination forecasting, which is in practice the approach used by most serious professional analysts. The logic is simple. Fundamental forecasting is strong in the medium to long term but weak in the short term. Technical forecasting is strong in the short term but ignores the underlying economic reality over the long term horizon. Why choose one when you can use both, each where it is strongest? In a mixed forecasting approach, fundamental analysis is used to determine the direction and magnitude of the exchange rate movement over the medium to long term. Where are inflation differentials heading? What is the trajectory of the interest rate? Is the current account balance improving or deteriorating? These fundamentals tells you the broad direction the exchange rate should move over the coming months and years. Technical analysis is then used to determine timing, the short term signals that tells you when to act within that broader fundamental trends. Even if you believe the rupee should depreciate over the next year based on fundamentals, technical signals can help you identify the specific moment to enter a hedging position or to make a currency trade. Many institutional currency analysts and fund manager formalize the combination by assigning weights to the fundamentals and technical forecast, say 60% weights to the fundamental model and 40% to the technical signals, and blending them into a single composite score. The weights can be adjusted based on which approach has been more accurately recently, making the process adaptive. Now, regardless of which approach you choose, fundamental, technical or mixed, no forecasting model is perfectly accurate. Exchange rates are influenced by an almost infinite number of factors, many of which are inherently unpredictable. Forecasting error is not a sign of bad model. It is an inevitable feature of any forecasting exercise. Forecasting error is defined as the difference between the forecasted exchange rate and the actual exchange rate that materializes. A positive error means the model overestimated the exchange rate. It predicted a stronger rate than what actually occurred. A negative error means the model underestimated. It predicted a weaker rate than what materialized. The goal is not to eliminate forecasting error. That is not possible. The goal is to minimize it systematically over time and understand the nature of errors so that the model can be improved. To measure and track forecasting accuracy, analysts use several statistical measures. The first is mean absolute error or MAE, the average of the absolute differences between forecast and actual values. It is easy to interpret because it is expressed in the same units as the exchange rates. An MAE of rupee 1.25 means that on average the model forecast were off or were wrong by rupees 1.25. The second is the mean squared error or MSE, which squares each error before averaging. The squaring means that large errors are penalized much more heavily than small ones. A model that is consistently slightly wrong will have a lower MSE than a model that is usually right but occasionally very wrong. The MSE is useful for situations where large errors are particularly costly. The third is the mean absolute percentage error or MAPE, which expresses the error as a percentage of the actual value rather than in absolute terms. This is particularly useful when you want to compare forecasting accuracy across different currency pairs or different time periods where the absolute level of the exchange rate varies significantly. Together, these measures gives a comprehensive picture of how accurate a forecasting model has been and help analysts identify whether their models need to be recalibrated, updated or replaced. Let us now close today's lecture. We began today by establishing why exchange rate forecasting matters and studied the three main approaches to it. Fundamental forecasting uses macroeconomic variables, technical forecasting uses historical price data, and mixed forecasting combines both. And finally, we acknowledge that all forecasting involves error. In our next lecture, we move into the practical mechanics of the foreign exchange market, where we will explore exchange rate quotations, cross currency calculations, and how exchange rates are actually computed. I look forward to seeing you there. Bye for now. Thank you.